All right, we're just getting started. Mm, I hope I kick this cough soon. You know, it's one of these things when you have that really bad cold in the winter. Hey, thanks so much for joining me. I'm Mitch Goldberg. You're watching my live stream. It's about money, the stock market, investing, personal finance, so many things to do with money. Anyway, thanks so much for joining me. We're going to talk about some really important things today. Yesterday, and I'm still harping on yesterday, the most important thing was Bank of America's earnings and comments from the CEO of Bank of America, Brian Moynihan, that he said the consumer remains very strong, even in the face of inflation. Today, we have other earnings, two big earnings reports that keep that I think keep lifting markets. I should say, keep lifting optimism, which could potentially keep lifting markets. That's a better way to say it, right? So I'm still harping on yesterday, but I'm going to roll the intro. We're going to talk about Netflix. We're going to talk about UAL, big earnings reports, quick up and down of the markets, and why I want to reiterate that I think yesterday was really reason to be positive. I said yesterday, I think I have confidence in this rally. Like, I'm becoming more optimistic. It feels good. Welcome back, optimism, my superpower. Hello, superpowers. So let's just roll the quick intro, and then we're gonna have a good, quick show. Don't miss it. You want to wait till the end. We've got some good stuff at the end. Here we go. And we are back. Thank you very much for joining me. I'm Mitch Goldberg. We're just getting started. Okay, excuse me. We're just getting started. You're watching a show about money. We talk about the stock market a lot. It's fun. It's exciting. There's more to it than that, to personal finance, but it's a big thing. We need to be prepared. We need to understand what's going on, and we need to once in a while say what's going on. And sometimes we need to actually ignore it. But today is not that day. Andrew is out there. Thank you very much. So, everyone, while you're watching, if you don't mind, if you're watching during the live stream or during the replay, give us a thumbs up or a heart, an applause reaction, whatever, or a wow, maybe, whatever reaction is available to you, depending on which social media platform that you're watching from. And if you have any questions, that's what the comments are for. I love hearing from you. So please ask me your questions or just say hi, what's up, mingle, mix it up a little bit. It's always more fun like that. I see James is out there. Thank you very much for joining me, James. And so let's just take a look at some important things. I want to follow up on yesterday. I said yesterday was a really good day, and I said I don't think the rally is a one-hit wonder. Uh, rallies have a way of. I've said I don't like big rallies like up 500 plus days because they have a way of breaking your heart a day or two later, and then they just get repealed because they're just oversold bounces on the way to lower lows. Now, did we see the lows yet? I'm not going to play that game. It's like somebody wants to ask if you saw the lows so they could shove it up your, if you're wrong about it. No, 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 no. We're not doing that. Okay. Not it's a fool's errand. We may have. I think we're in the vicinity of saying that I think you'll be very happy if you invest now over the long term. But I would say that on any day of the year, year high or year low. So I think that's important to know. If you're worried about risk and you want your stocks to work out, but you want to mitigate risk, one of the things you could do is extend your time horizon. Don't invest for 6 months or a year. Make sure you're investing with a 10 or 20-year time horizon. You'll be much happier and much less likely to be disappointed. But if you're just short-term trading, short-term investing, swing trading, I don't really think I think it's very easy to be faked out, even if things are good a year from now. we don't know what things are going to be like in the next 6 months. Okay, so having said that, you do what you want, I'll do what I want. What I want to say is the rally yesterday I thought was a sticky one. I think it's meaningful because of the way it worked, because of what led it, which is bank stocks, bank earnings from JP Morgan, from Wells Fargo, Bank of America. I saw a pretty big acquisition. Was it USB is making a pretty big acquisition in the regional banking sector? The point is, banks are very, very strong right now. Banks are doing great. And banks' financials overall are big enough as far as a sector goes in the major averages to actually help lift them. When energy does great, oil stocks have done very well this year, but the energy stock representation, for example, in the S&P 500 is so little that it didn't really make a difference for the index. Okay. Now you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Just want to make that clear. There is a difference, even if the expense ratio in an index fund is almost is minuscule. There still is a difference. In any event, what we need to understand is banks, the financial sector, really is big enough to pull the market with it. But the real deal, and I want you to pay attention, this is the most important thing you're going to hear throughout this whole market cycle that we're in the toward the end of 2022. The strong earnings from banks, the good news, the revenues, the rise in net interest profit, in net interest margins, it tells you that our worry that there's another Lehman Brothers disaster out there, that there's another, nuclear bomb tucked away somewhere in the financial sector, it's not there. That's what it tells you. The financial sector in the United States is nothing like it was in 08. And the strong earnings we're seeing from banks tells you that we could stop worrying about some Lehman style financial nuclear bomb like we had in 2008. That was a spark that just crushed markets, so long ago. Okay, 14 years ago. I can't believe it was 14 years about this month that Lehman Brothers went down. It actually got last month. So September of 2008. We're hearing about Credit Suisse and Deutsche Bank, two huge European banking giants who are much bigger than today than Lehman was back then. Although inflation adjusted, I don't know if that really makes sense to say that. However, that kind of scenario is off the table. That's what I think. Which it removes doubt. It helps alleviate fear. Investors are now willing to buy bank stocks. Banks are healthy. Banks, when they're healthy, they lend. They might slow down lending. They might raise lending standards, but they lend. They don't grind to a halt the way they did in 2008. And then the federal government, the U.S. federal government, had to bail out the whole banking sector. And then the European Central Bank and the Bank of Japan and the Bank of England and the Bank of Switzerland all had to do the same thing in their respective countries. Everybody had to do it. So that's why this is such a significant day. Well, yesterday was so significant. Why it's significant today. We had follow through today, another update in the market. The rally held, but it's holding for good reason. Let's take a look at a couple of things. This is so significant. Here we go. Let me get rid of the social media icons, put myself up here. Okay. Netflix, after the market closes, Netflix has become one of the absolute market disasters in 2022 after being one of the market darlings during the pandemic. Remember, this was a $700 stock. Okay. Remember that? It was $700. Went to 162 now, then to 240 at the close, which is not a terrible deal, by the way, if you were willing to buy it. But after market trading, it's up 14%. up $33 a share. That's in dog years, up to $274. And Netflix crushed it. Okay, their earnings report just came out. Okay, it just crushed it. I don't know where the where is it? Hold on. All right, it doesn't really matter. Netflix crushes expectations across the board, adds 2.41 million subscribers. That is significant. On top of that, in another area of the world, another area sector of the market, United Airlines shares surge on higher profit and strong demand forecast. Okay. By the way, Emmett just subscribed to my YouTube channel. Thank you very much, Emmett. Emmett, I just saw that. So uh, many thanks. Much gratitude to you, sir. Thank you. Um, so how is that stock doing? There's the plane. United Airlines is up 7% today after market trading, after being 3% up in the regular session. So over 10% move. That's significant. So we have two different sectors, an industrial, like United Airlines. Obviously, it's transportations, but it's in the industrial sector. And Netflix in communications/technology. This is big news. Emmett, while we're here, Emmett says dead cat bounce. Good earnings means the Fed needs to continue to tighten the economy. It continues to raise rates to slow things down, as we aren't in a recession and inflation won't settle down. This is the start of a dead cat bounce. Emmett, it could be. It could be a dead cat bounce. That's why I say I don't want to get into the business of saying, uh, you know, I'm so stuffy. I don't want to get into the business of saying we're at the low, we hit a low, we're going up from here, we've already seen the lows. We don't know. Hey, you don't know what you don't know. That's why it could be a bounce. But I think it definitely I think the news as of late helps us coalesce around the lows that we've already seen. And I think it makes it less likely that we see new lows because of the news we've seen, in my humble opinion. But it could be a dead cat bounce. We could sink and go to new lows. And that's why we kind of are fighting with one arm behind our back, because we're still so paranoid and jaded. And remember, investor sentiment is rock bottom low. It's as bad as it was in 2008 when Lehman Brothers went out of business. So, in fact, it's even a little bit worse. And institutional investors are very under allocated in stocks. But these could be bullish things, at least for a really good dead cat bounce. How good of a dead cat bounce? Well, we'll see. But if the dead cat bounce gets big enough that it starts to clear hurdles like, substantial moving day averages, the 100, the 200, et cetera, then it could have staying power. And all of a sudden, you could start to get better news from the economy, or you could start to see improved news on the inflation front. And all of a sudden, we have ourselves a true rally that's sustainable, and possibly even one that could break us out of the bear market that we're in. Okay, it remains to be seen. I think we could all agree on that, and I don't think you're wrong by saying what you said. If things are too good, the Fed raises interest rates too much, and that puts the kibosh on all the good optimism that's been generated lately. Okay, so I hear what you're saying. So let's keep going. Let's go back to that. Let's go back to the major markets. Okay, so the Dow. Let me make this a little bit bigger. That's too big. All right. The Dow up 337 points. I think it was up at one point like 600. It was up a little over 600 earlier in the day briefly. Then it was only up like 200. And then people said, oh, the rally's petering out. We're going right back down. But by the end of the day, it was up over 300 points. Not a bad follow through, up over 1% on the day. That's pretty good considering what we had yesterday. Nasdaq up 96 points, just about 1%. S&P up, the winner, up 1.14%. Gold continues to trade lower. Energy continues to trade lower. The VIX continues to trade lower. Tell me how these aren't bullish for now. Okay, at least I'm paying homage to Emmett because now I'm like really, you're keeping a lid on me, which is good, which is very very good, by the way. Okay, let's take a look at bonds. So basically, from the 6-month T-bill 4.4%, all the way to the 30-year 4%. Basically, the whole yield curve is above 4%. So we went from a Tina market to a Tara market. Tina means, you may have heard this before, there is no alternative. So investors had to buy stocks for income, for dividends, and for growth because interest rates are so rock bottom low in bonds. So bonds weren't giving any competition to stocks. But now we're in a Tara market. There are reasonable alternatives. So now bonds are giving stocks a run for their money. And it is strange that the 30-year is lower, 4.02%, than it's lower than the 6 month at 4.4%. It's a very, very inverted yield curve. We can talk about what that signifies later. Okay. We talk about it all the time. So let's just move on here. The winner of the day are the economically sensitive stocks that you would expect to see work out when you have a real rally. Industrials, building materials, well, utilities aren't so economically sensitive, but financials had a good day, continuing to have a good day. Consumer discretionary, and then everything else was up. Healthcare, communications, technology. It's hard to find something that you don't like about this day. And we can always find things you don't like about it. But overall, I think it was a pretty good day in the market. I think the beat goes on. We're expecting 0.75% hike from the Fed in November, half a point in the December meeting, and then we'll have to take a look at what happens early 2023 in terms of what the Fed does. But I, for one, continue to be more optimistic or guardedly optimistic or less pessimistic than I was because I think the financials, which are leading now, are big enough of a sector to make a difference for the overall market. Remember, when the financial sector is healthy, the economy isn't so bad. And maybe that's the story of the day, that we became overly pessimistic on both the economy and the stock market. Thanks so much for watching. I greatly appreciate your time. I'll be back tomorrow with more good stuff coming your way. Have a very good rest of your day.